Ultimately, inflation is going to cause recession. And what is the government going to do to stimulate the economy in recession? Create more inflation. What would be happening to the U.S. economy if interest rates were 10%? We would be in the worst recession ever. Inflation is expanding the money supply. So what I said was that the inflation that the Federal Reserve was creating and calling quantitative easing was going to result in big increases in consumer prices. Well, I knew that QE was inflation, and it was only a matter of time before that inflation showed up in the official CPI figures. But one reason it took so long is because those numbers are a lie. Those numbers are probably underestimating the true rate of inflation by at least 50%. So all the years that Paul Krugman was bragging about inflation being below 2%, it was actually quite a bit above 2%. It's just that the government was lying about it. And so Krugman and his buddies were bragging about low inflation that didn't exist. Now, it wasn't up in the stratosphere. We didn't have double-digit inflation, and there were a lot of reasons for that. There was a big lag in the true impact that inflation had on consumer prices. One reason was because of our enormous trade deficits, where we were able to export all the dollars we printed abroad, and so we were able to import real stuff and export our paper. If we couldn't do that, if we had to spend all the money the Fed was printing here in America, if we didn't have access to the world's production, thanks to the dollar's reserve currency status, we would have seen a much bigger increase in consumer prices. Because when inflation is making assets go up, people think they're richer and they're not worried about it. Now, one thing people were complaining about was the widening divide between the very rich and everybody else, because as inflation pushed up asset prices, those assets were disproportionately owned by the very wealthy. So one of the effects of all this inflation was to widen the gap between the rich and the poor. Now, that should have been something that Paul Krugman should have been against, because he's supposedly the champion of the little guy, of the downtrodden. Yet the policies that he was advocating were making the rich richer and keeping the poor poor, or actually making the poor poorer by driving up their cost of living. But what's happening now is that we're finally seeing a much more pronounced effect of quantitative easing on consumer prices. Ultimately, inflation is going to cause recession. And what is the government going to do to stimulate the economy in recession? Create more inflation. And what's amazing to me is the fact that nobody is questioning any of this. How come nobody is saying, wait a minute, the Fed's about to start raising rates next week. They're going to lift off and rates are going to go up by 0.25%. We're going to go from 0 to 25 basis points. Inflation is already 7.9% officially. Unofficially, who knows where it is, maybe double that amount. But even if you accept the government's doctored up version of reality that inflation is 7.9, why isn't anybody saying maybe a 0.25 point rate hike won't cut it? Maybe it's too little too late. Maybe even if the Fed raises rates 7 times this year, which a lot of people don't think they'll do. They think it's going to be fewer, maybe 3 or 4. But let's say the Fed manages to raise interest rates all the way up to 1.5% by the end of the year. Why is nobody saying, what if that's not enough? What if that doesn't work? What if you can't put out a 7.9% inflation fire with 1.5% interest rates? In fact, I don't think there is any historic example of inflation this high being extinguished with interest rates this low. Why is nobody saying, what if we have to really raise interest rates? What if at the end of the year, it turns out that the inflation rate went up and not down? What if after 5 or 6 or 7 0.25 point rate hikes, the year-over-year inflation rate hasn't gone back down near 2%? What if it's gone up? What if it's closer to 10%? What if it's higher than 10%? Nobody is asking these questions and saying, what if the Federal Reserve has to raise interest rates to 10%? And what if they can't raise it to 10% in quarter point increments? What if they have to go medieval? What if they have to just raise interest rates from 1.5% to 10% in one swoop, in one meeting? And what if 10% isn't even high enough? What if by the time the Fed realizes that their go slow quarter point rate hike approach was ineffective and didn't work and actually fueled an even bigger inflation fire, what if they have to go even higher than that? Nobody is considering the impact that that's going to have, because it's going to be catastrophic. All this debt that's out there, corporations have been selling all this low yielding debt, and they've been using the money to buy back their overpriced stock. What's going to happen when that debt matures and now they got to roll it over and interest rates are 10%, and so corporate rates are 12% or 13%? How are they going to roll over that debt? What's going to happen to corporate earnings when all their money goes to debt service? And what's going to happen to corporate earnings when their customers are spending all their money on their debt service and can't buy their products? The stock market is going to crash. And of course, the stock market would crash by definition if interest rates went up that much, because stock prices are a function of interest rates. You're discounting the future value of their earnings. So not only would earnings crash if interest rates were 10%, but the discount rate that you would use to value those collapsed earnings would be much higher. And so stock prices would be eviscerated. What about the banking system? The banks would fail. If the banks suddenly had to pay 10, 11, 12% interest to their deposits, yet they have portfolios of low yielding long-term debt, they would all go bankrupt. And then what would happen to the depositors? They would lose all their money, because the FDIC doesn't have any money to bail out all these banks that would be insolvent in a high interest rate environment. And in fact, what about the government itself? The government would be insolvent. We have a $30 trillion national debt financed with T-bills. The average rate right now is 1%. The government is spending $300 billion in interest on a $30 trillion debt. Well, if rates go to 10%, as all that low yielding debt matures and has to be rolled over at a 10% rate and not a 1% rate, now you're talking about $3 trillion a year in interest payments, not $300 billion. And of course, what would be happening to the U.S. economy if interest rates were 10%? We would be in the worst recession ever. In addition to the fact that the interest cost is skyrocketing to service the debt we already have, but the government would be racking up record debt, even more than it racked up during COVID, in an economic catastrophe that would be brought about by 10% interest rates. I mean, we had a very severe recession when rates went to 20% in 1980, but a rate of 10% would do far more damage now than 20% did then, because we had a much stronger economy.